Hi everyone, it's Ari here. I wanted to make a short video on Valeant Pharmaceuticals, which has been grabbing the headlines for the last couple of months. As you can see on the stock chart, the stock declined from around $250 a share to a close on last Friday of 22, which happens to also be almost at the 52-week low of 21.95. And if you're not familiar with this story, this was a company that grew through acquisitions. They didn't really do any R&D. This is a pharmaceutical company, but they would acquire companies and raise the drugs prices, and there's been a lot of backlash about these kind of companies that buy companies and raise prices. And and then there was what kind of tipped the scale was that there was a specialty pharma division called Philodor, which is it's a very technical part of the business, but there were claims that there was some fraud in that part of the business, and it was denied at first, but then they did investigations and they found that there was some suspicious prescription filling. So they would fill Valeant drugs when actually the doctor had not specifically asked to fill Valeant drugs. So anyway, there is some element of fraud, and Valiant's response was to close down the relationship with that division, which wasn't a very big division, but it brought a lot of bad publicity and press to Valiant. So I wanted to shed some thoughts on why something small could really tip a big company into distress. And it really comes down to some concepts that we talk about in finance about the indirect costs of distress. So if you go bankrupt, then there may be direct costs of distress, like you may have to pay lawyers and you have to pay lots of fees. But those are usually around 2% of, say, the enterprise value at the time of the bankruptcy. But the vast majority of the costs that companies face related to distress are called indirect costs, and those are related to how customers respond to the fact that the company is distressed, and how the suppliers respond to how the company is distressed, and how the lenders respond. And Valiant's business model was perhaps one of the worst for indirect costs of distress. You have a company that's growing through acquisitions for a long time, and that's a heavy external finance strategy, right? So they relied on a high stock price and the ability to issue debt in order to fund their acquisition program. And from 2014 to 2015, their debt went up something like $15 to $20 billion because they acquired Salix. And so, as you can see, they really required a lot of external finance in order to move the business forward. And when the news broke out about this perhaps fraud, then all of a sudden the markets became concerned that the company was a much bigger fraud perhaps than that small division, and that eliminated their ability to access external finance. And when they lost the ability to access external finance, they could no longer fulfill their acquisition programs and grow at the rate that the market thought they were going to grow. So a lot of the stock price in Valeant, I'll show you, is a lot of the stock price is really growth related. So if we go to financials, I'll just show you now. If you look at their balance sheet, right, they have about 5.6 billion in equity value on the books, but that includes a lot of goodwill and intangible assets. So you can see this is from the latest quarter. They have about $40 billion of goodwill and intangible assets, and so equity is 5.6 billion if you include all those intangible and goodwill assets. But if we wipe out, and they haven't really written down any of these assets despite all of the mania that's been going on in the stock, and I really think that they probably should take some impairment charges here. And so if we take the 40 billion and we write down half of it, then all of a sudden you have a negative $15 billion of equity value, right? So there was a lot of growth, a lot. I mean, what these tangibles are features of the business, oftentimes the brand. It could be relationships that will generate cash flows in the future. And so it doesn't reflect assets that the company actually has today. And it only reflects the assets that will be arriving in the future due to the benefits of brand and relationships. But if we think that that's impaired, we probably should write it down. I usually write it to zero, but let's say you write it in half, you have now a negative $15 billion book value of equity. So this goes to show, this numbers right here show you that a lot of growth was assumed in the stock price. And because of the loss of access to external finance, you suddenly see a reduction in growth. And then that leads to something else, which is that once you can't grow as much and your stock price falls, you lose your ability to achieve that growth or those future cash flows that would be used to service your debt. And so people become a lot more concerned about your leverage. And I've read a lot of articles that talk about how Chesapeake and Freeport-McMoRan, which are major energy companies, had also a lot of concerns about their debt, but then they were able to restructure their debt, and then since then their stock price has gone back up a lot. But this is a very different kind of company. Again, all of these assets, these $40 billion in assets here, are intangible. They don't actually exist. Someone may be willing to pay for them, but they're probably quite impaired given all the negative publicity around Valeant, and it's unlikely that they would fetch $40 billion worth of value. And if this company was actually liquidated, which it wouldn't be, then there's no way you would recover these goodwill, and you probably recover very little of them. So Freeport-McMoRan and Chesapeake, which are these energy companies, they have actual assets, right? They have the value of the mine on their books, and that is a tangible thing that already exists today, and they can sell claims to that to raise cash, and that's what they did. Freeport sold stakes in their mines in, is it New Guinea, Papua New Guinea, or maybe just in, so they sold stakes in their mines and were able to raise cash that way to relieve their debt concerns. But I don't think that's something that Valeant is able to do. And I was reading through their earnings call, and it seems like they're focused on paying down debt from cash flows, but they're not really considering spinning off any assets to accelerate that pay down. And it's probably because they don't really have, I mean, they have the Bausch & Lomb, which are the contact lens solution, and they have Salix, which is a new dermatology product. But there's 40, it's so, and we didn't look at their debt yet. So they have $32 billion in total debt, which is quite substantial. And last year you can see if I do annual mode. So you can see last year it was $15 billion of total debt. So they really increased their debt capacity quite heavily right before this fraud was discovered, and they got a lot of negative publicity, and they lost access to external finance. So a lot of this is related to indirect distress costs, which is the loss of external finance, now the debt concerns, and that's causing these suppliers and the customers. The customers are like Walgreens and doctors and patients, and because of all the negative publicity and because of the distress potential around Valeant, people are less willing or interested in working with Valeant, which in turn hurts their ability to create cash flows, which in turn makes the distress worse and and there's a cycle that starts. So that helps explain why a company that looked very resilient to many people when it was 200 and even at 100, and people thought this was going to blow over, I think they underestimated how big these indirect costs of financial distress can be. So the stock, is it cheap at 22? I think they have still a lot of indirect costs of distress, and the only way to get through this is time. And it's something they talked about on the earnings call. Time is the friend of Valeant. It is if you survive. So they seem to be generating substantial cash flows to cover their debt, but they did have to get they do have covenants on their debt, and they did have to get the lenders to relax those covenants in order to continue. So they have some of the covenants relaxed until March of 2017, and they think that that's enough runway time. But the fact that they had to get the covenants relaxed already suggests that they are actually in distress, and they're on somewhat the knife edge of what is viable in terms of these covenants. So when the problem with a company that's close to their covenants is that you start to lose a lot of control as an equity holder. It starts to become more that the debtor has a control, or not the debtor, but the debt holders have more control. I mean, they are the ones who are deciding whether or not to push Valeant into bankruptcy, and it's not a great position to be in as an equity holder, and so the stock price is down. So those are some of the. So I think I haven't heard a lot of people talk about the indirect costs, but I think that is the major issue here. So, but now the stock is quite low. It's trading almost at book value of equity, but again, this book value of equity includes $40 billion of intangible assets, and I probably wouldn't consider them. So this is not a value stock. This was a growth stock, and it still is a growth stock. But there are a number of smart investors in this company, and we all have heard of Bill Ackman, and he is on the board, and he's a very involved shareholder and has been very vocal about how Valeant is a good company and so forth. But fewer people have really considered some of the other investors, and I know of this one quite well, so I just wanted to mention them. So to find out who holds a company's stock, I like the website whalewisdom.com, and then once you're there, you can type in the company, or if you know the owner, the institution that holds the shares, you can type in that institution's name. So here I typed in, for example, SQ Advisors, and then I pulled up this page. Now, this is Lou Simpson's fund. Lou Simpson was the fellow who managed the money for Geico under Warren Buffett. And Warren Buffett mentioned that, or remarked a couple of times, that Lou Simpson's probably the most intelligent investor, or perhaps has a better track record even than Warren Buffett. And he's still managing money. He left Geico, and he manages now money, looks like $2.6 billion. And so he's a very wealthy person. It's mostly family money. And you can see what he holds, and I strongly suggest that you look through his holdings. But he does hold Valeant right here. And he's been holding them since Q4 of 2011. So if we go back to the stock price, Q4 of 2011, so the stock was around 49. This is when he entered. And he was quite correct. The stock went from 49 all the way up to 250. That's 5 times the money. So that's a very, very good investment. But it's obviously backfired. So what's interesting is you can see, if we go to, so we can see this is as of the filing for his holdings as of December 31st. You can see that between October 1st and December 31st, he acquired actually another 750,000 shares of Valeant. So despite the stock falling, you can see here what happened. So despite the stock falling, So between here, August 1st, which is October 1st, so we don't know where he purchased it, but we can see that between October 1st, which is around 180, and December 31st, which is around 100, he bought another 750,000 shares. So at least at the outset, he took advantage of the price fall and thought that it was attractive. And then if we look at March 31st, so this is what bothers me. So when we look at March 31st, the next 3 months, we see no addition and there's a slight subtraction, but really he's maintaining his, he hasn't sold really. I don't consider this a sale of 100,000, it doesn't matter. So he hasn't really sold, but he hasn't increased, and that's surprising in some sense, because if we look at what happened to the stock price between January and March, the stock went from 100 to 27. And so I guess it's only been down here at this level in the 20s, 30s for a couple of days by then. So I'm curious to see what he did in the April, May, June period. But it does bother me a little bit that he wasn't buying more if he thought it was very mispriced. But anyway, I think he's a very smart person, and he is a holder, and he did increase his stake as the stock was falling, and so I have a lot of respect for his opinion. But my own analysis, and I'm not the expert on Valeant, but I know that financial distress, the indirect costs are quite large, and we're seeing, and this company depends on external finance, and they depend on a lot of relationships with external players like Walgreens and doctors and patients, and a lot of the brand of Valeant has been tarnished. Recently, though, also, if we look at activity, we can see that the CEO, or the board member, Papa Joseph, he purchased in June 13, so just a few days ago. Actually, he purchased on June 10th, but reported just a few days ago, he purchased $5 million worth of his stock. Now, this is a quite sizable amount, considering the fact that a lot of these shareholders have lost a lot of money. Then they're still putting in a lot more, but right now it's a little, it's not obvious, because no one has really been taking advantage of this decline in price in a meaningful way. This is the first trade that I'm seeing of an insider who actually is taking advantage of the fact that the price is now $22 a share. And the CEO sold 100 million. We can see that in November, which is right around here, right around, I think it was trading around 80 to 100 at that point. And yeah, he sold it 78. He sold, but that was a forced sale. Supposedly he was margining a lot of his holdings, and when your value of your securities declines enough, then you have to sell to satisfy your margin requirements. And so that's what he said that was. It's a margin call. So he says it was a forced sale, but actually it was a very lucky sale, because it went from 78 down to 22. So I'm not sure whether that was insider information or just, as he said, a forced margin call. But we do see at least one insider now voting for Valeant, but I would wait, and I would want to see a couple of more. If it was such a good deal, there's a lot of people looking at this company, and I don't believe just one person is going to take advantage of the turnaround here, right? So in some sense, the fact that there's no more people here is a black mark, in my opinion. But that might change if I see more buying. And I had I'm looking at, this is their 10K filing, and I had their debt schedule. Yeah, it's right here. So we can see, if we look at their long-term debt section, so they have a very complicated capital structure, and with lots of different debt, and they do always have a summary table, though, of the maturities in the next couple of years. And you can see that they don't have very many maturities for 2016 and 2017, so they can probably satisfy these with the cash flows from operations. But then they're going to face some pretty steep increases: 3 billion, 2 billion, 8 billion, 16, or so 8 billion in 2020, and then this is thereafter. So they are going to have to turn around the company. And what worries me is that right now, when I was reading their earnings call transcript, so on Seeking Alpha, you can find the earnings calls transcripts for each quarter. If you look at what they're talking about the business, it looks like they're focused on stabilization. So this Joseph Papa. So another thing is he's been at the company for 1 month. It says here, I've been with Valeant for approximately 1 month now. But if you've only been there for 1 month, then you probably have to buy shares. He's the guy who bought the shares, right? He probably has to buy the shares as part of his contract, because oftentimes these employee contracts require you to hold a certain amount of stock, maybe relative to your salary. And so that actually reduces even more the significance of this insider purchase. So really, the black mark here is, if Valeant is so cheap, why is no one on the inside buying Valeant stock? And unless there's some active transaction in process that blocks them from doing so, I'm very concerned by the lack of insider buying. Where's the so they're talking about the stabilization process for Valeant, which he thinks will take 3 to 6 months. This is the stabilization process. This would then be followed by a turnaround stage and ultimately a transformation stage. So first we have 3 to 6 months of stabilization. Stabilization is when your patient is on the operating table and you're trying to keep them from bleeding out to death, right? That's kind of where Valeant is right now. And there's going to be a lot of uncertainty for another 3 to 6 months about whether we can stabilize this company. And really what they're talking about is, can we reduce these indirect costs, and can we get people to respect us again and do business with us again? Because that's the only way that they can get out of this distress. This is going to be followed by what they're calling a turnaround stage. And this is left pretty vague. But during a turnaround stage, usually companies are paying down their debt, so trying to relieve whatever the distress is at the moment, and not really focus on growth, but more just thinking about sort of turning around from and recovering. So this is like physical therapy. After you have your accident and you survive the operating table, then you need to do a little bit of physical therapy. But then ultimately they're going to have a transformation stage, which is going to be a multi-year process. Now, this is very vague, transformation stage. So that says that Valeant's business model and objectives are going to have to change permanently. So the type of business Valeant was, which was one that acquired drugs, didn't really do R&D, and then raised the price on those drugs, is probably not going to be sustainable going forward. They also are going to have to focus on perhaps spinning off or reorganizing the company in a way that, so they have a variety of different divisions. Maybe the sum of the parts is worth more than the whole, so they may have to break up this business. But transformation is very vague, and it's going to last for multiple years, they say. So this is a company that is definitely not a value investment, right? There's a lot of transformation happening here. You don't like transformation, actually, when you are looking for a value company. Buffett says you want to be able to close the market, get no information, and then be comfortable that everything is going fine for the next 10 years. And you definitely cannot say that with Valeant. Valeant is on the operating table, bleeding out, and even for the next couple of years, there's a big question mark about what Valeant is going to look like. So Valeant is not a value investment. And a lot of people are looking at the stock price, I think, and saying, okay, the stock price is at the new 52-week low. Is this a time to buy? And I think these people are misplaced. That until this business shows that it's surviving the operating table and can pay down some debt, you still that's a big question mark. And then the sort of what is this business going to be? And it's really hard to imagine how the market is correctly figuring that question mark out. So I think that Valiant is something to stay away from or avoid for the time being. And if you want more information, they have a lot of presentations on their latest presentation is an annual meeting. This is on their investor relations website, and they talk about some stuff here. They don't really give you anything that's like, okay, this is very clear goal. They talk about the current state of the business. They call themselves distracted, right? That's exactly what indirect costs are. So the employees of the business are leaving because they don't think Valiant's going to survive. That's an indirect cost of financial distress, right? They need to be able to attract those people back and incentivize them. But with a collapsed stock price and with a bad reputation, it's harder to attract talent. And a lot of this business of just buying companies and that whole acquisition program a lot of that is about talent and reputation, right? People don't want to sell themselves to Valiant if Valiant's reputation is not good. So that whole growth strategy for Valiant is really off the table for a while. They also made a huge acquisition for Salix, this dermatology drug, and now it's experiencing speed bumps. There's significant challenges related to profitability, which is in part due to the fact that the organization is very distracted. And there's some speed bumps in the Walgreens program that they're starting to replace the Philodor program that was fraudulent. And so they say negative publicity has impact. So this is exactly what indirect costs are. Negative publicity is impacting our reputation with patients, physicians, payers, and shareholders. I've seen this happen a couple of times where you have these growth companies that grow through acquisition, and they end up going bankrupt because these indirect costs kill their ability to operate. And it's not only the fact that they lost their reputation. That what happened is that when their reputation is hurt, they lose access to external financing and to their original growth story. A lot of the stock price, I said, was growth. So the stock collapses. When the stock collapses and people start to get worried about the growth or the growth slows down, then the cash flows that you expect to achieve are lower, which then makes you concerned about paying the debt. And this all spirals, right? And I've seen this happen a couple of times, so that companies that might have been fine are no longer able to survive, even though the underlying assets are fine. And I think they have some good businesses, but when you have $31 billion of debt and the equity on the books is worth pretty much zero, in my opinion, if this thing hits bankruptcy, the equity is going to get wiped out. There's no real claim in this business to something tangible. Like at least with Freeport McMoran and these other mining companies, you had a claim to a tangible asset to back you up if in the event of a bankruptcy. So I'll keep an eye on this company. It's been very popular, but as it gets cheaper, I'm worried that people are going to start jumping in. But this business is not stabilized, and you can see on the stock price, you can see that this company, the stock is just falling, right? This is a falling knife. It fell, and then Ackman came out and said he was buying, I don't know how many hundreds of millions of dollars of the stock. Lou Simpson even was buying the stock, and yet it collapsed again. And in my opinion, this stock is not going to. It's not going to be. It may continue falling. It's a falling knife. My rule is that you never catch a falling knife. You wait for it to stabilize, and the stock price will it's very unlikely that the stock will just leap, and that's usually what investors hope for. It'll probably first stay flat for a couple of months, a whole quarter, and then start to move upward slowly, and then it'll accelerate. Unless they do some major restructuring, but it's harder for these guys to do that. So Freeport did that, I think, but Freeport had actual assets that they could sell claims to, and Valeant really has to sell claims to unrealized growths, like their assets that don't actually exist. And I think that's a lot harder to do. So I don't think you're going to see a dramatic improvement in the stock price. I think you're going to see something of a slowdown in the fall, and then a turning around, gradual turning around of the price, and then maybe over a couple of 6 months or a year, you'll see the price recover. But until I see more insiders taking advantage of what people seem to be thinking of as an opportunity, I really don't think that one should enter this stock, right? If this is a real opportunity, insiders should be buying much more heavily, and the stock price shouldn't be falling. A lot of smart money is responsible for moving the stock price, right? On a day-to-day basis, it's not the retail investors, it's the smart money who are moving the stock prices, especially in a very big company like Valeant. And these guys are selling. And I think there's very good reason. Their covenants had to be relaxed for the next couple of months because they're right on the covenants. And that means the debt holders have a lot of claim, or a lot of power here. So in summary, I think I was looking at Valeant because it's at 22 all-time new low, but I still don't think it's attractive at this price. And I would need to see a reduction in these indirect costs and more insider buying before I would feel comfortable with this company. But even then, it wouldn't be a value investment because there is no tangible assets that are backing up your claim. So in the event of a liquidation or a default, you wouldn't get very much. You would get nothing. So this is definitely still a growth stock or a speculative investment. But that's my opinion. Thank you for listening.